My name is Melisa Lloyd. I am the owner and financial advisor of American Executive Tax and Financial Services. I'm also a certified tax specialist. So starting my own business, of course, was scary. I was a single mom and decided to quit a $40,000 a year job and go 100% commission. So I did not have a choice as to sink or swim. I got the education that I needed and I swam. I have 3 goals for my clients. Number 1, we want to lose the least in a down market. Number 2, we want to gain the most in the up market, but that's based on risk tolerance, obviously. And number 3, really big one, is pay Uncle Sam the least amount possible while doing those. So tax deductions, I think, are better for a small business simply because they allow each individual business to take the deduction in the year that it's given, but 80% of those losses can be carried over for 20 years, whereas tax credits depend on the type of business and if they get them that year. So definitely tax deductions. So it depends on the business, honestly. If it's a small car washing business where somebody's just going to start up with basically a Schedule C, once the basic is covered of earning at least $26,000 or more, you might want to consider going into an LLC as an S Corp. An S Corp allows pass-through income, and it also allows you to pay yourself some W-2 wages and then also the ability to have some K-1, which from the pass-through corporation. So that's all based on revenues. Once you reach a specific revenue, because if you're operating as just a 1099 income business, you're going to pay a heck of a lot more in Social Security and Medicare tax than if you actually elect to go to some kind of corporation and seek a tax advisor's advice. The tax jobs cut of 2017 was the latest big one for small business owners. It cut out some of the fringe benefits of per diem and the QBI for each individual business, and the deductions that they can take were changed. They don't pay enough in taxes during the year, and then they try to underestimate their income. Underestimating your income is good when it comes to tax time, but then when you actually need some kind of financing in the future as an individual or the business itself, that's not a good thing. And then a lot of do-it-yourselfers don't know all of the different tax deductions that are allowable out there. So when the laws changed back in 2018 for the standard deduction to be raised starting at $24,000 for a married couple filing jointly, it pretty much got rid of everybody able to be able to itemize. Because the standard deduction was raised and they took the exemptions away, the standard deduction was raised, so most people can't reach that threshold. So they really don't. They're loans, so therefore they're not based as income, and so they're non-taxable. And the only thing that you would have anything to do with taxes would be the interest. You'd be able to write it off as a tax deduction. If you require a person to be there at a certain time and you require them to leave at a certain time, they must be an employee. So you have to do their W-2 for them. As far as a subcontractor, a 1099 employee or a worker, so to speak, they basically make their own hours. They don't have any reporting, have to be there. They can work from home, different things like that. So the benefits of W-2 to the employee versus 1099, the employer pays half of the self-employment parts. So that's your Social Security and Medicare. Employer pays half, the employee pays half. When an employee or a worker is 1099, they pay both sides. So your effective tax rate is the actual income that you have divided by the income taxes that you pay. So if you made $100,000 and you paid $25,000 in taxes, your effective tax rate is obviously 25%. Your marginal tax rate can range anywhere from 10 to 37% and is based on how much income you made and also your filing status. I don't recommend any software for a do-it-yourselfer. There are so many deductions that can be lost in the sauce when a person is doing it themselves. It is much more beneficial always to have a professional tax preparer prepare your taxes. So no, they're not a red flag, but you have to be careful on how you actually claim them. You can do a percentage of your home base, but it has to be used for the year for that portion. If you work outside of the home, a designated area that you actually use inside of your home, so a certain square footage or a percentage, and then you get a percentage of the different deductions as well. Yes, an S Corp allows you to file as an LLC, so you don't have the liability, and it has pass-through to save you on Social Security and Medicare tax. It avoids double taxation like a C Corp might. If they reimburse, it's actually beneficial to them because they can write off 100% of the amount that they've actually reimbursed. If the employee contributes, they can actually, that is not reported as taxable income to them either. You need to make sure, whomever you use, that they have the proper education. CPAs are always wonderful, and EAs become CPAs. An enrolled agent actually works with, a CPA can actually speak to the IRS on your behalf. An enrolled agent can actually speak to the IRS on your behalf. And then there's tax accountants and tax specialists. So you want to make sure that they're up on the most current tax laws, and you want to make sure they have the education behind them and experience to make sure that they get the benefits for you as much as possible.